Ladies and gentlemen, good day and welcome to 3Q and FY26 post-results conference call of Punjab Chemicals and Crop Protection Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star, then zero on your touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Manish Mahavar. Thank you, and over to you, sir.
Yeah, thank you, Mark. Warm welcome to all the participants on the call of Punjab Chemical and Crop Protection. From the management, we have Mr. Shailij Shroff, Managing Director, Mr. Vinod Gupta, CEO, Mr. Devender Gupta, CFO, Mr. Bishan Singh, Head Finance on the call. Without further ado, I would like to hand over the call to Mr. Vinod Gupta for opening remarks, post which we will open the floor to Q&A. Thank you, and over to you, Vinodji.
Thank you, Manish, and good afternoon, everyone. And thank you for joining us today for this investor call for the third quarter and 9-month ended on 31st December. I am joined on the call currently by our CFO, Mr. Devender Gupta, and our finance head, Mr. Bishan Singh. Mr. Shroff may join in some time as he is traveling right now. We sincerely appreciate your time and continued interest in our company. I trust you have had an opportunity to review our financial results and investor presentation, which are available on the stock exchange and on our website. Let me begin with the overall market scenario and challenges. As most of you are aware, as you are tracking the industry, that global agrochemical industry continues to face persistent headwinds marked by supply-demand imbalances, channel inventory correction, pricing pressure from Chinese capacity, and volatile raw material costs. While export demand has improved significantly with the normalization of global inventories, realizations remain capped. Margins across the industry are expected to remain stable to slightly soft, with market favoring low-cost producers, with export breadth, that is registration and the product basket, and also with strong working capital discipline. Domestic demand is was dependent on the monsoon, and the late floods this year impacted the seaweed season adversely. Demand has remained weak due to weather-related disruptions, and obviously there is a lower crop and horticulture prices, which is also seeing demand pressures. As such, our presence in agrochemical in local market is limited, and for the product what we make for local market, demand has been stable. We at Punjab Chemicals are adapting to market situation with focus on new product addition, efficiencies and cost, and we have demonstrated remarkable resilience. Our performance in first 3 quarters of the current year is a testament to our diversified business model across agrochemicals, performance chemicals and industrial chemicals. As all of you would have seen our numbers, revenue from operations for the quarter stood at 246.6 crores, reflecting a growth of 15.3% year on year. Our gross margin for the quarter stood at 41.9%, whereas EBITDA was 29.6%, which is 12% EBITDA margin. Prices have remained soft, but our volumes and capacity utilization across various divisions has remained healthy. Our strategy to build sustainable growth is yielding results, which is built on 3 pillars. First one is product innovation and diversification. We continue to invest heavily in R&D to introduce new products, mainly focusing on products which are on reasonable volume, reasonable size, but which are not sort of commodity, where we believe that value addition will be higher and we can meet the global regulatory standard. New product launched in recent years are contributing significantly, and these are growing at the rate of 15 to 20% in coming years. In order to cope up with the demand for the products, we are investing to debottleneck our capacity and also new production blocks. This expansion also aligned, as all of you are aware, government is giving a push for Make in India with a lot of policy changes. So we believe that our expansion is timely to capture these opportunities. And also Third pillar for our strategy is operational excellence. We continue to focus on operational excellence, continue to focus on efficiency, so that we remain competitive and maintain market share for our existing products. At the same time, we continue to focus on our expanding our customer base, chemistry capability, strengthening our customer relationship, which is helping us to expand our product portfolio. The progress on the MOUs, we had signed 3 MOUs last quarter. Product progress is satisfactory, and we are confident that the commercialization for these products will happen in FY27. Our in-house R&D work and some pilot trials is focused on products which are going off patent both in agrochemical and specialty chemical space. On the manufacturing front, our previously announced capex plan is progressing on schedule. The new manufacturing block is under development to support the growing demand. Also, alongside expansion, we continue to focus on asset renewal programs. Last quarter, we took a revamp of 2 production blocks to improve safety, efficiency, and reliability. We continue to evaluate new manufacturing location to support our medium to long-term growth strategy and enhance our supply chain resilience. So I will conclude my comment by saying that we remain confident in our strategy and our ability to deliver long-term value to our shareholders. Our robust Q3 performance, coupled with strategic capacity expansion, product innovation, positions us for a strong recovery as the industry condition normalizes. With this, I will hand over the call to our CFO, Mr. Devendra Gupta, to give financial highlights for the quarter and the year so far.
Thank you, Vinodji. Good evening, everyone. Thanks for joining us for our Q3 and 9-month FY26 earnings call. I'll now provide a summary of the financial performance for the quarter and 9 months period ended December 31, 2025. On the quarterly side, our revenues from operations stood at INR 246.6 crores with a growth of around 15.3% on year-on-year basis. The domestic market contributed around INR 138.2 crores, while the international market contributed 108.4 crores to the total revenues. Gross margin for the quarter under review stood at 41.9%, an incremental of 1.9% on year-on-year basis. EBITDA for the quarter was INR 29.6 crores with a strong growth of 53.5% on YOY basis. The EBITDA margin also stood at 12.4%. Profit after tax for the quarter stood at INR 13.8 crores, growing by 127.7% on year-on-year basis, and PAT margins stood at 5.6%. For the 9 months period, the performance is as follows. Revenue from operations stood at INR 121.2 crores, growing by 17.6% on YOY basis. The domestic market contributed INR 450.6 crores, while the remaining 370.6 crores was contributed by international markets. Gross margins for the 9-month period stood at 37.7%. EBITDA for the 9-month period was INR 90.6 crores, growing by 23% with margin of 11.0%. PAT for 9 months period stood at INR 53 crores with a growth of 66.2% and PAT margin of 6.5%. Our capacity utilization across all manufacturing sites remained healthy during this period. The agrochemical division operated at around 78% capacity utilization, the performance chemical division at 60%, and the industrial chemical division continued to operate at the near optimal level of around 85%. With this, I now end my financial highlights portion and open the forum for Q&A. Thanks to all.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Rahul Jain from Credence Wealth. Please go ahead.
Hello. Am I audible?
Yes, sir, you're audible. Yes, sir, you're audible. Please go ahead.
Yes, you're
Thanks
audible.
thanks for the opportunity. So, the first question is on the CapEx side. So current year till now, what CapEx we have done in 9 months, and what further CapEx is expected to get completed in March 26, and what is the CapEx for March 27? And if you could segregate that between the growth CapEx and the maintenance CapEx.
So, for this year so far, our capex is roughly about 30 crores, and we will be investing another 10 crores in the year, so total will be around 40. Out of this, roughly about 22 CR is for asset renewal and compliance and other aspects, and about 18 crores is for creating either a flexibility in production blocks or capacity expansion for the new product that we have added in last 2-3 years. So that's for this year. I hope that answers your question.
And FY27?
FY27, because our major capital expenditure for the new block will start coming in from March onward, so we expect the new block to take about 70 crores. And next year also, we have not done the budgeting exercise, but capex for asset renewal as well as for capacity expansion or for capability enhancement will be the similar ranges this year.
Okay. So, basically, with the year end, so the capacity at peak utilization, what kind of sales could be possible given the current prices? Post the completion of CapEx.
Given the current price levels, post the completion of capex, suppose if you are talking about FY27, we should be able to easily do roughly about 1400 to 1500 crores based on the capacity that we are creating. And the product that we are planning to add are also slightly higher price. I'll not say very high price, but they are in the range of $17 to $20 kind of a price.
And so the new products contribution, you had mentioned in the previous call, we have reached around 16% of the revenue. And in terms of the new product commercializations further in the current year, you had mentioned that in FY26, we will finally commercialize total 5 products, out of which 2 had been already done till Q2. So currently, at what stage we are in terms of commercialization of the balance 3 products for the current year? And typically, what kind of contribution these 5 products can, incremental contribution from these 5 products can be in the next FY27 and FY28?
So I think, as you know, the new product addition generally, the volume increase is a slow process, because first we have to give some commercial lots, which are typically small quantities of 5 to 10 tons. Then gradually the volume ramps up, and the full potential is realized only in 2 to 3 years' time. As far as the commercialization of these products is concerned, in fact, we are already at the stage of commercializing more products than what we had initially projected. So last quarter we commercialized one more product. For that, samples have already reached the customer, and if based on whatever we have done, next year we are expecting handsome volumes, and 3 to 4 more products we are planning to do commercial trials in Q4. So broadly this year our new product addition will be in the range of 5 to 7 numbers. That's what we are projecting. Overall, it's difficult. I will not be able to say product wise, because some products are very small in volume but high value. Some products are over a period of time can become high volume, but the value will be reasonable. Overall, all these 5-6 products put together, we can expect a contribution in 2 to 3 years of about 150 crores coming from these new products that we have tried in this year.
So when you speak about MOU, you had spoken that MOU, 3 MOUs, each of the MOU can be around 50-60 crores. So the total incremental MOUs can contribute about 150 crores, roughly that sales. So within these MOUs, are we talking about these new products also a part of the MOUs, or these are 2 separate things?
These are 2 separate things. MOU, as I mentioned, Commercialization we are expecting in FY27, not this year. So far the progress has been that we have actually initial part of the technical due diligence is completed, our product samples have been approved by the customer, and now we are in the process of final agreement signing, where we are now thrashing out final details of the overall arrangement, which is sort of a long-term firm agreement with all the three parties. But this will happen in FY27. So these two are two separate things.
The benefit of MOUs will start occurring from second half of FY27?
I think yes. I mean, let's take it to full year, because all the three probably will be happening at a different stages, because of the complexity. I mean, say for example, when we have to do a final agreement with a Japanese customer, sometimes it may take up to 6 to 9 months just to get the agreement done. But broadly, the timeline is FY27 in phased manner for all the three products under MOU.
And just one last question, sir. Your initial commentary, you spoke about prices still being stable, but no increase further, and demand continues to be good. So with this latest announcement by China in terms of cancelling the export tax rebates for certain pesticides from 1st April. So how do you view that this exercise? Do you feel the sentiment could be better, say, from April onwards in terms of the agrochemical pricing?
Yeah, I think this withdrawal of export benefit is on a very selective basis. It is not across the board. It has been product specific or some particular chapter numbers, which does not cover any of our products at the moment. But our belief is that this is beginning of withdrawal of export and tax benefit by China. Over a period of time, they will probably move to more and more products, and they will withdraw this export benefit. So at the moment, I mean, if you ask me from 1st April onwards, our products may not be impacted, but we have to keep a watch, because how does China exports get impacted because of this duty withdrawal on limited product? If it is a severe impact of export from China, probably they'll come back in this area, because I think their economy is being driven mainly by exports. So that's the way we see it. But in long run, we definitely foresee that export benefit withdrawal will be a process which Chinese government will follow.
So do you expect overall agrochemical pricing improvement in, say, next 1 or 2 quarters, or it will take some more time?
I think there may be some uptick, because we have seen improvement in some products, but this improvement is a 3 to 4%, not significant. So it will be product specific rather than a general industry phenomena.
Thank you so much, sir. I wish you all the best.
Thank you, Mr. Rahul.
Thank you. Participants who wish to ask a question may press star and 1. The next question is from the line of Jatin from Swan Investments. Please go ahead.
Good evening, sir, and thank you for the opportunity. Am I audible?
Yes, Mr. Jatin, you're audible.
So the couple of things just wanted to clarify. You indicated that the 3 MOUs that we signed for the export-oriented products, one which is from Japan and other 2 will be from other region. So all 3 together will be accounted for 150 to 180 crores of the incremental revenue over the next 2 years?
Next 2 to 3 years, because I think first year will be just commercial quantities, first trial lots. Once the product acceptance is there, gradually the volumes will go up. So let's take 3 years actually.
So 3 years on the cumulative, so all 3 together will be 180 crores on a cumulative basis, right? All 3 products, 3 MOUs.
Yes, right.
Right. And on the overall side, because I guess this MOU which we are signing, it's more of a CDMO, so definitely we'll have a better profitability as compared to our existing product. Is it fair to understand that?
I think that's a fair assumption, that these MOUs will be at a higher profitability than the current product basket, and and these are also sort of exclusive arrangements that we are getting into.
But sir, any rough guidance can you give? Suppose if you're at 12% margin, these MOUs could be 100 or 200 bips higher, or probably more than that in terms of the profitability.
Let me take that. Jatin, hi, this is Shalil here.
Hi, sir.
Please understand that during these calls, sometimes, we have to be very diplomatic in giving numbers. But as Vinod definitely said, that these are niche products and this will have a better incremental than what Punjab has been performing over the years.
Okay, sir. Sir, on this commercial production that which is under trial, 4 products which is going to commission in Q4. So what will be total market size of this 4 new products which will go under trial production in Q4, and when could start the commercial?
So basically, Jatin, please understand that these are under secrecy agreements, but these markets will grow as we get registration. But as narrated by Vinod, that we expect in the next 2 to 3 years to get a revenue of around 180, and on the upper side, it could be double of the same.
So, no, sir, I'm not talking about the 3 MOUs that you have signed, but I'm talking about the production trial that will be taking up 4 new products in Q4. Is that a part of strategic partnership, or that are the 4 different products?
So these are 4 different products that we are commercializing.
I'm sorry, I joined late, so maybe Vinod.
You joined late, so these 4 products we are commercializing this year, and over a period of time, even these will add about 150 crores kind of a revenue in next 2 to 3 years. Now, Mr. Jatin, your question is, obviously these will be at a higher margin. As Shalil said, it is difficult for us to announce, but overall market is much bigger than what we are targeting. So we are taking a conservative number there.
So that means the 4 new products and 3 MOUs can probably give us an incremental revenue of 300 crores at the existing capacity of Lalru and Deravasi, right?
With the new capacity addition that we are doing. That's why we are getting into a new capacity addition.
Okay, so the new block that we are probably doing it will add another 300. So
yes,
the indication that you gave to the earlier participants that existing capacity can give a 1,400 to 1,500 crores of revenue in FY27. So is it safe to assume that this 300 will be over and above that, or it's that 50?
No, I think, Mr. Jatin, my response was that including the new blocks that we are creating, overall the revenue that can be generated is about 400 to 500 crores, which includes 300 crores roughly from these new products, and then growth in existing products, whatever we are doing, all put together.
And now once we look at your export trend, definitely, sir, it's picking up. But when you compare with your FY23 numbers, which was much on the higher side, where we probably did an export of near about 530 crores, and in FY25 it was somewhere around 350 crores. So the decline in the overall export is largely attributed to a volume, or it was more on the pricing?
No, I think what is happening is, as the market situation is very dynamic, so even the supply chain shifts are happening. So some of the export products that we were earlier exporting to, say, Europe or Japan, they were getting formulated in those countries. Now some customers have started basically some formulation in India and exporting. So overall, our product export of our products remains the same, or it is growing at 5 to 7% year on year. But because now we are selling some of that volume in local market because of this shift in supply chain, you are seeing that shift. So I'll summarize that our export market share for our all 3 products remains healthy, steady, and it is growing year on year. But this shift is mainly on account of supply chain changes that are taking place in view of the global dynamics.
So given this trend of the exports, so if you can help us understanding how was the month of January for us?
I think, Jatin, you're going a little bit too much in detail. But, as Vinod said, that we definitely, the business trend is healthy, and we expect that the year end also should be very good.
Okay, so then, and once we probably reach around 1,400, 1,500 crores of revenue in next 2 to 3 years, is it safe to assume that we'll go back to 15% EBITDA margin?
Yeah, as we said, that as we have already narrated to you, that the newer products is getting better margins. So definitely the trend of Punjab in terms of gross margin, and at the bottom level will definitely improve.
Yes, and Sanjay, one last question. Last question from my side. So, from last 2 to 3 quarters, more than that, we are probably looking at the setting up of a new facility. And have we finalized, because we are looking somewhere in Maharashtra, Gujarat, is something on card, or probably as of now our focus will be more on expanding our new block in Derabasi and Lalru, and probably after that we may look at the new site. How shall one look at it for the future growth drivers?
I think we have already commentated in couple of our calls between 1 and 2 con calls that we have looked at certain sites. Unfortunately, because of due diligence, it did not fall in place. And at the moment also, we are looking very seriously at 3 sites, which is happening. And as and when it comes in, presumably, I believe that we need a site which is absolutely on our radar. And as and when it happens, we'll definitely inform all of you, and including the stock exchange.
Sure, sir. Thank you. That's all from my side. All the best.
Thank you. Ladies and gentlemen, to ensure management can answer all questions, please limit your questions to 2 per participant. The next question is from the line of Preeti Agarwal from SK Associates. Please go ahead.
Yeah, thank you so much for the opportunity. I wanted to know that in Q2 you mentioned exports and domestic demand are structurally 50-50, but timing and accounting affect quarterly mix. So, post Q3, has there been any structural shift in customer ordering behavior or geography-wise demand?
So I think, as I mentioned in the response to Mr. Jatin earlier, this balance continues to be in that direction. However, there is a structural shift happening on the supply chain side. Some customers are now taking material in India, they are formulating it, or the next process is being done in India and being exported. So net, our product in export market and our market share for those products continue to remain steady, or in some cases it is growing. So I think our exports have been healthy. That's all I'll summarize.
Good. And with Rabi season now underway and some normalizations expected, how should we think about domestic recovery in Q4 or even early FY27, especially for legacy agro molecules?
See, our presence for local product is very limited. We do only 2 or 3 products, and they are not for this season. So anyway, most of our production for in Q4 is for export market and for very niche customers. Most of our products for domestic market are meant for the monsoon season, and we have already started campaign for those products based on our customer requirement.
Understood, sir. That's it from my side. Thank you so much.
Thank you, Ms. Preeti.
Thank you. The next question is from the line of Pratik Shah from Investing Alpha. Please go ahead. Mr. Pratik, requesting you to kindly unmute your mic. Mr. Pratik, you're not audible. So can we move to the next participant? Since there is no response, we will be moving ahead. The next question is from the line of Viral Jain from SNG Finance. Please go ahead.
Yeah, hi. Am I audible?
Yes, sir, you're audible.
Yes, you're audible.
Yeah, thank you for the opportunity. So I've got a couple of questions. So my first was, during the last quarter, the management have highlighted that there was a margin pressure from the fuel cost shock and the power inefficiency due to the natural calamity of flood. So can you break down how much of the Q3 margin recovery is due to the normalization of this one-offs versus the structural improvement from the product mix and efficiency gain?
So I think this year, even after the flood season, because of the crop was not good, the fuel prices continue to be high. So we have not seen a significant relief in Q3, and the shelling, because we use rice husk as the fuel, shelling for rice is still not streamlined and the quality is not good. So prices of fuel continues to remain high. So whatever improvement you are seeing is mainly attributed to the change in product mix and efficiencies.
Got it, sir. And can we expect any margin recovery out of this?
I mean, I think Q4 is not looking, I mean, I see that Q4 fuel prices probably will remain at the same level, based on whatever estimates we are getting from the market. But overall, product mix will continue to help us in terms of improving our margins in Q4.
Got it, sir. And my next question was with regards to the EBITDA. So given your earlier guidance of EBITDA of 11.5 to 12.5% for FY26, so should we view the Q3 margin as a normalized run rate, or do we expect some moderation in Q4 due to the block shutdown and trial runs?
I think we will maintain this run rate, and that's the range we are very confident to deliver on a consistent basis.
Got it, sir. And my next question was with regards to the debottlenecking. So one block shutdown has been taken in Q4 FY26 for debottlenecking at Dirabashi. So what is the expected net capacity gain post this exercise, and will there be any short-term revenue impact in Q4 FY26 Q4 due to this shutdown?
So first is there will not be any impact on the revenue in Q4. We are expecting this capacity to come back online by mid of February, and this will give a very good incremental revenue for FY27. We have not completed the market projection and budgeting exercise, so we probably will keep it for the next investor call. But overall, we are very bullish about the demand for the product where we are doing debottlenecking.
Got it, sir. That was really insightful. My next question was with Lalru capacity. So this capacity utilization has been steadily improved from 60 to 70%. So is this incremental utilization primarily driven by the new product, or can we expect recovery in the existing modules? And where do you see this steady state utilization over the next couple of years, let's say 2 years?
So we continue to work on improving the capacity utilization. We continue to rationalize the product mix and also capitalize on some spot demands that is coming from market to improve our capacity utilization. So strategically, we are looking at improving Lalru capacity utilization from current levels to healthy levels of about 80%, which should happen in next 4 to 6 quarters.
Okay, and any future outlook?
I mean, that's overall, I think we continue to grow at 15 to 20% year on year, and we continue to maintain that forecast. And I think earlier participants asked some very specific questions about product addition and their growth prospects. I think that should give you a very good clue around the journey that we are taking.
Got it, sir. Got it. That was all from my side. Thank you.
Thank you.
Thank you. The next question is from the line of Isha Murthy from Mars Investing Capital. Please go ahead.
Hello, sir. So my question is, like in Q2, you indicated new products contributed around 16% of H1 revenue. So where does this contribution stand after Q3? And what is the targeted share over the next, say, 12 to 18 months I'll take into?
I think what we have been presenting, that overall our share of new products will gradually go up. Last year was about 12%. This year we expect it to be around 15 to 16%. And gradually we will be moving towards 18 to 20% of our businesses from the new product that we have introduced in last 24 months. So that's the kind of metrics that we are targeting. And we are working on R&D product development initiatives and our customer reach initiatives to make sure that we meet these targets.
Okay. Also, sir, just a follow-up question on this. Like, can you clarify whether these products are incremental to the 5 products which we have discussed in Q2, or they are the part of the same pipeline? And what will be the margin profile? Like, should we expect to one scaled?
I think there are two ones. First of all, we are giving at an overall level that will continue to increase contribution from the new product gradually to say 18 to 20% over the next 2 years. So it can be, it will be mix of these products because market situations change. But overall, the product that we are adding will contribute to that kind of a share on the revenue. And as we have indicated in earlier response to other queries, that the margin profile also we are trying to improve from 12% to 15% over a period of time. And that's where the higher contribution from new products will help us.
Okay, sir. Got it. Thank you.
Thank you.
Thank you. Participants who wish to ask a question may press star and 1 on the touchtone telephone. The next question is from the line of Pratiksha from Investing Alpha. Please go ahead.
Hello. Yeah, hi. I'm audible now?
Yes, sir, you're audible.
Yes, Mr. Pratik, you're audible.
Yeah. Thank you for the opportunity. So my question is on the R&D expenditure. It is said to be doubled over the next 2 years. So can you link this higher spend to specific outcomes like number of commercial molecules, backward integration projects, or margin uplift, so investor can track the ROI?
So I think broadly, if you see, we have been indicating the share of new product in our revenues, which mainly comes from the R&D effort that is being put, and we have been indicating that this share will continue to increase. Also, we have been also talking about improving our operational efficiencies, yields, which also requires a lot of R&D effort. And all the investments in the assets and manpower is directed towards improving our product portfolio. So we'll continue to hold market share in our existing portfolio where we have globally dominant position, and at the same time make sure that we make healthy inroads for the new product that we are introducing. Now, I think that's the way we will continue to project our numbers.
Okay. All right. My next question is like backward integration has been cited as a key margin lever earlier. So are any of the current or upcoming products meaningfully backward integrated already? And what gross margin delta do you typically target from such integration?
So I think as far as backward integration is concerned, we generally split it into 2 parts. One is obviously we do a few things in-house. For a couple of products, we have already started that exercise. For some other products, we identify a local supplier who is able to compete against the import prices, and that exercise also has been successful for us. All these things basically are giving us, currently, because the market conditions are tough, is helping us to sustain our margins. And as the market conditions improve, it will help us to improve our margins. It's difficult to give that additional contribution because currently the prices are low. This will help us in a big way when there are price shocks. So we are actually preparing ourselves for any future shocks, which has been typical market phenomena coming from China every 2 to 3 years.
Okay, sir. Got it. Thank you.
Thank you.
Thank you. Participants who wish to ask a question, press star and 1 on the touchtone telephone. As there are no further questions, I hand the conference over to Sir Manish.
Yeah, just Vinodji, just have a few questions. So in terms of these molecules which we are commercializing, 4 molecules in 4Q, 3 or 4 molecules in 4Q, and MOU what we have signed right for next year, 3 more MOU. So can you maybe give some indication in terms of which segment this cater to, agro, pharma, or spec chem, this 7 or 6 or 7 molecules?
So total out of these 7 products that we are talking about, 3 are from agrochemical sectors.
Okay.
3 are intermediates and 1 is performance chemical. That's the broad segment.
Okay. Intermediate, it is also related to your ag chem only.
Intermediates, I think out of these 3 intermediates, again, 2 are for pharma and 1 is for agro.
Okay, understood. And in terms of it's purely all the 7 are for export market or domestic?
It's a 50-50% market share.
50%. Okay, understood. Okay. And can it possible to share revenue breakup of 9 months in terms of agro, pharma, and your spec chem business?
Well, this is an integrated business, and I think we basically, that's why, because there is a lot of integration that takes place between one business to another business. So I think at an overall level is what we project the numbers, and I think that's the way we will continue to show the numbers.
Sure. That's it from us, and all the best.
Okay, thank you. Hello, Mr. Manish, we are done, or?
The next follow-up question is from the line. So we do have a follow-up question.
Okay.
The next follow-up question is from the line of Jatin from Swan Investments. Please go ahead, sir.
So just wanted to understand your mix of between the domestic and export, which is currently around 70-30. So if you probably, when you are doing at a 1,500 crore to the top line, how do we see that mix changes from the current level over the next 2 to 3 years?
See, Mr. Jatin, as I told you, what's happening is there is a lot of supply chain shifts are happening. Now, say for example, some of our customers today who basically take technical directly from us in a particular geography are already in discussion with us, can the product be formulated here? That is maybe because of the better distribution network, better cost, whatever be the reason. But so that in terms of the number that we project, because whatever we export directly gets counted as exports. So broadly our share will remain 50-50 even for the new products. But when you look at the number, it will depend on the supply chain, how the customer wants it before the product is placed in the market. But if I look at all the share of the product, it will remain at 50-50 roughly.
Sure. And second question is more on the technology front, which you highlighted in your presentation about the 3 technologies. So can you throw some light on all the 3 different technologies that we'll be using it?
Just a minute. Which point are you referring to? Just a minute. So technology basically, I think we have talked about 3 new products. And technology, what we have introduced is obviously a market. I mean, it's not technology but chemistry. So we have talked about hydrogenation as the capability that we are adding, mercaptan chemistry that we are adding, and we are also adding pressure reaction. So these are the 3 new things that we are adding to our capabilities.
Okay, but I mean, all these technology we are adding. So when could one can see a product coming from this chemistry? I mean, over.
That's what. So I think some of the products that we are doing right now are involving these technologies.
Okay, some of the products are already involved. Okay, sir. That's all from my side. Thank you.
Thank you. That was the last question. I now like to hand over the conference over to the management for the closing comments.
Shalil bhai, are you there? Shalil bhai?
So has left the like he has disconnected.
Okay. So first, so let me take over this. So thanks a lot for the interest, and I'm sure that we have been able to answer most of your queries in the call. And we continue to remain confident about the growth and the profit margin improvement over the next few quarters. And this year, already we have shown that kind of a growth. And our product pipeline looks healthy to deliver the kind of performance that we have been committing. Thanks a lot, and wish you a good day.
Thank you. On behalf of Antique Stock Broking Limited, that concludes this conference. Thank you for joining us. You may now disconnect your lines.